Hi, I'm Vikesh Mehta and I'm here to present the Q2FY14 earnings review of the Sharekhan's banking universe. In Q2FY14, the earnings of the Sharekhan's banking universe declined by 13% year on year, led by a 35% decline in earnings of the public sector banks. On the contrary, the private banks fared better as their earnings grew by 22%. The decline in earnings of the public sector banks was largely on the back of rise in NPA provisions and rise in provisions of the mark-to-market losses of their bond portfolio. The operating profit of the public sector banks declined by 3.6% year on year, led by a compression in NIMs, higher operating expenses and lower growth in the fee income. Whereas for that of the private sector banks, it grew by 25% due to lower operating costs and stable margins. The asset quality issues continues to haunt the banking sector, especially for the public sector banks, whereas that of the private sector banks, they manage the risk in a better way. The slippages continues to remain high for the public sector banks, although they were lower than the previous quarter. On the restructuring front, not much respite is available in this quarter over the coming quarters, as the additions to the restructuring pipeline continues to remain high. Given the trend in the economy and the stress in the sectors, we believe the asset quality issues are going to remain high for the public sector banks over the next few quarters. On the outlook front, the second quarter of FY14 was quite challenging given the steps taken by the RBI to curb the rupee volatility, which led to a decline in which led to a tightening of liquidity scenario and high bond yields. Going forward, we expect the earnings of the public sector banks to remain weak given high credit costs and pressure on their margins. Therefore, we remain selective in our picks and we prefer ICICI Bank, Axis Bank and Federal Bank from the private space, as well as Bank of Baroda from the public space. At the moment, we continue to avoid public sector banks from the mid-cap space despite their low valuations, given their volatility in their earnings and weak capital positions. Thank you.